What if the next great power conflict wasn't fought with soldiers and tanks, but with money? Imagine this. It's February 28th, 2026. A regional conflict in the Persian Gulf suddenly explodes onto the world stage. In an instant, 20% of the world's crude oil supply is shut down, and the price of oil skyrockets to over $120 a barrel. The International Energy Agency would be calling it the single largest supply disruption in history, a shock that would make the energy crises of the 1970s look like a minor speed bump. But as painful as the price at the pump would be, that's not the real story. The real story is what a conflict like this does to the foundation of America's global power, the dollar. While the headlines focus on military strikes and tanker movements, they'd be missing the bigger picture. This isn't just a hypothetical war for territory. It's a direct assault on the petrodollar system that has guaranteed American economic dominance for nearly a century. In this video, we'll break down how a conflict like this could be the trigger that finally ends the dollar's reign, and what could happen next as the world scrambles to build a new financial order. To get the sheer scale of what we're talking about, you have to look at a map. The Strait of Hormuz is less than 21 nautical miles wide at its narrowest point. Through that single choke point passes roughly 20% of the entire planet's daily oil consumption. In this scenario, since the conflict began, Iran makes it clear that this waterway is no longer safe. It's effectively been weaponized. Through drone swarms, missile threats, and direct warnings, Iran could create a de facto blockade. The immediate results would be catastrophic. Nearly 3 million barrels of daily Iraqi oil output would be stranded. Qatar Energy, one of the world's biggest producers of liquefied natural gas, would be forced to declare force majeure on its exports, basically saying it can't fulfill its contracts. But it wouldn't just be military threats freezing the market. The insurance industry would deliver a knockout blow. Marine insurance premiums for any vessel even thinking about passing through the Gulf would surge by an astronomical 500%. That makes any commercial transit economically impossible, even with a naval escort. The risk is just too high. The global shipping industry would grind to a halt in the region, taking a fifth of the world's most vital commodity offline overnight. And the shock wouldn't stop at crude oil. The Strait of Hormuz isn't just an oil artery. It's a critical pipeline for a ton of other essential goods. The region supplies about 30% of the world's fertilizer. A disruption there promises to drive up food prices for billions and raise costs for the entire agricultural sector. Commodities like helium and sulfur would also be caught in the crossfire, hitting everything from medical equipment to industrial manufacturing. Take aluminum. Gulf states produce around 9% of the world's supply. Imagine if a targeted strike hit a major facility like Emirates Global Aluminium. In that situation, we could see aluminum prices jump 8% in a single month, sending ripple effects through the auto, aerospace, and construction industries. This cascading failure of supply chains is a recipe for a global inflationary storm. While central banks might hope the conflict would be short-lived, that optimism would fade fast. The World Trade Organization could warn that if these high prices persist through 2026, global GDP growth could be slashed by 0.3%, a huge blow to an already fragile world economy. A war like this would expose just how vulnerable our interconnected system really is. For most Americans, the first and most painful impact of this crisis would be at the gas station, with average prices potentially surging to $4.10 per gallon. Now, you might argue the U.S. is more insulated from this today than in the 1970s. It's true, America has become a net oil exporter, which helps. But that doesn't make the country immune. Lower-income households who spend a bigger chunk of their budget on fuel and food would be hit the hardest. Economic research has shown just how sensitive the economy can be. A major sustained increase in the price of oil can push annual inflation up significantly. With a price surge of 60% since the hypothetical conflict began, the pressure would be immense. And while the US feels the pain, Europe would face an even bigger crisis. As a region that depends heavily on energy imports, its GDP growth could fall by at least 1% below forecasts, threatening to push the continent right into a recession. The financial markets would reflect this global panic. Stock markets from New York to Tokyo would tumble, and a massive sell-off would hammer the bond market as investors flee from risk. The first domino, the military conflict, has fallen, and its economic shockwave would circle the globe. So why is this kind of war so much more than just an energy crisis? To understand that, we need to talk about the system that's been quietly running the world for the last 50 years. For those who don't know, the petrodollar system is the main reason for the US dollar's global dominance. It was born out of the 1970s. After the US detached the dollar from gold in 1971, the world needed a new reason to trade in dollars. The solution was a brilliant deal with Saudi Arabia. The US would provide the kingdom with military security. In exchange, Saudi Arabia would price all its oil exports only in US dollars. And, crucially, it would invest its extra oil profits, its petrodollars, back into US Treasury bonds. This deal, soon adopted by all of OPEC, created a permanent, artificial demand for the US dollar. Any country that needed oil, which was basically every country, first had to buy US dollars. This gave the United States what's been called an exorbitant privilege. It allowed the US to run huge deficits, printing and borrowing money to fund its government and military without the inflationary consequences that would crush any other nation. This system is the invisible engine of American power. And it's this system that is now under attack. Now, a fire like this doesn't start from nothing. The erosion of the petrodollar system has been happening for years. The old security for oil relationship between the US and Saudi Arabia has been shifting, with the kingdom looking to diversify its economy and its foreign policy under its Vision 2030 plan. It's begun signaling a willingness to accept other currencies for oil, like the Chinese yuan. This drift was supercharged by another trend, the weaponization of the US dollar. The aggressive use of sanctions, especially freezing Russia's foreign reserves after the 2022 invasion of Ukraine, sent a shockwave around the world. Nations started to see their dollar holdings not as safe assets, but as potential hostages. This kicked off a frantic search for an alternative. This is where the BRICS bloc, Brazil, Russia, India, China, and South Africa, became so important. With its recent expansion to include major energy producers like Saudi Arabia and the UAE, BRICS started building the architecture for a post-dollar world, promoting trade in local currencies and developing payment systems that could bypass US control. The system was already fragile. All it needed was a push. The conflict that erupts in our 2026 scenario is that push. It represents what some analysts might call the kinetic collapse of the petrodollar system. One researcher at a major bank might bluntly call it a catalyst for the erosion in petrodollar dominance and the beginnings of the petro-yuan. Why would this conflict be different? Because it would strike at the heart of the original bargain. US military security in exchange for oil sold in dollars. For 50 years, the deal was that the US Navy would guarantee the free flow of oil. If the Strait of Hormuz is closed and the US is unable to secure it, that guarantee is shattered. Seizing this moment, Iran could make a strategic move of breathtaking audacity. It could directly target the petrodollar itself. In this scenario, Iran might inform countries that to get even limited passage through the strait, they must meet two conditions. First, stop all support for US military actions. And second, agree to settle oil transactions in Chinese yuan. This is no longer a theoretical debate about de-dollarization. This would be an explicit declaration of economic war against the dollar, using the chaos of a hot war as cover. This crisis becomes the perfect opportunity for China to execute its long-term strategy. The petro-yuan, oil traded in Chinese currency, is no longer a distant idea. It's happening in real time. China is perfectly positioned to capitalize. It's already the world's biggest oil importer and the top customer for both Saudi Arabia and Iran. Even before the war, a huge portion of Iran's oil exports were already settled in yuan to bypass U.S. sanctions. Russia has also pivoted east, conducting most of its energy trade with China in yuan and rubles. This war would force the rest of the Gulf to follow. With the U.S. security guarantee in tatters, they'd see their future tied not to Washington, but to their biggest customer, Beijing. China has been meticulously laying the groundwork for this for years. It has a vast network of currency swap agreements, its own CIPS payment system as an alternative to SWIFT, and a yuan-denominated oil contract in Shanghai. China wouldn't just be an opportunist in this crisis, it would be an architect, accelerating the transition to a financial system of its own making. So, what happens next? Let's explore two possible futures. The first, and more optimistic, is what you could call a controlled demolition. This isn't a sudden collapse, but a rapid, managed decline of the dollar and the rise of a multipolar currency world. In this scenario, the transition is painful for the U.S., but not catastrophic. The main consequence is a flood of U.S. dollars, once held by central banks, returning home. With countries no longer needing dollars to buy oil, they'd sell them off. This influx of cash would trigger persistent, structurally high inflation, unlike anything seen in generations. At the same time, the U.S. government would face a severe fiscal crisis. For decades, the world bought U.S. debt. With that mechanism broken, who will buy America's debt? The U.S. would be forced to offer much higher interest rates, causing borrowing costs to explode. The exorbitant privilege would be over. The U.S. would finally have to live within its means, forcing painful budget cuts and tax hikes, and leading to a decline in American living standards. For the rest of the world, this leads to a more balanced financial system, with trade settled in a basket of currencies, the yuan, the euro, the rupee. It would be the true beginning of a multipolar world. The second scenario is far darker, a chaotic collapse. This isn't a controlled demolition, but an uncontrolled implosion, a rapid loss of confidence in the US dollar that triggers a global financial crisis dwarfing 2008. This scenario begins with a run on the dollar. Seeing the US unable to secure the world's energy artery, global investors and central banks don't just walk away from the dollar, they sprint. They dump U.S. treasuries, causing interest rates to skyrocket uncontrollably. In the United States, this triggers hyperinflation. The cost of everything soars, savings are wiped out, and the currency enters a death spiral. A sovereign debt crisis becomes inevitable. The devastation wouldn't stop there. In this scenario, grim studies from groups like the United Nations could predict that a sustained war might wipe out over $100 billion in GDP for Arab nations. Investment banks might forecast that the economies of Kuwait and Qatar could shrink by an astonishing 14% annually. We could even see strikes on critical infrastructure like desalination plants, turning a financial crisis into a humanitarian one. Because the dollar is still the backbone of global trade, its sudden collapse would freeze the gears of the world economy. This isn't just a recession, it's a paradigm-shifting global depression. This explosive situation is amplified by powerful undercurrents already reshaping our world. First is the global energy transition. A financial system built on fossil fuels is inherently threatened by the shift to renewables. The petrodollar system was always going to decline. A war like this would simply compress a decades-long process into a matter of months. U.S. political strategy has also, paradoxically, played a role. While Washington has been accused by some of divesting from green industries, Beijing has been cornering the market on the essential minerals and manufacturing needed for the green transition. Finally, the rise of digital currencies is a technological wildcard. Central bank digital currencies, or CBDCs, like China's digital yuan, offer a new financial infrastructure that operates completely outside the traditional dollar-dominated system. Projects like China's M-Bridge are already testing platforms for instant cross-border payments that bypass the dollar entirely. This all leads to the ultimate question. What would the United States do? Would it double down, using its military might to try and reassert dominance? Or would it accept the new reality? So a 2026 war in Iran wouldn't be a sideshow. It would be the main event, the geopolitical earthquake that could finally shatter the foundations of the global financial system. The opening shots would be the starting gun on a race to redefine global power. We could be witnessing the violent end of an 80-year-old financial order and the chaotic birth of whatever comes next. Would it be a controlled demolition leading to a more balanced world, or a chaotic collapse plunging the global economy into a new depression? What do you think would happen? Is this a plausible future or just science fiction? Let us know your thoughts in the comments below. If you found this analysis valuable, make sure to subscribe and hit the notification bell. You won't want to miss our next breakdown as we continue to track the forces shaping our world.